going on, everybody? Oop. Right in the first few seconds, I already cough up a lung. That's what happens, right? So, I wanted to do a video today. I haven't done a video in a few days, just playing catch up at work. And I wanted to do a mortgage video because a lot of people have been asking me about mortgages. And I also have been looking for myself to see what's the best route to go down. Um, because it's not just credit score that matters, it's a lot of little things. So I came across this awesome document today from Lending Tree. Somebody sent it to me to read it. And I just wanted to share it with you guys. Like, some of the minimum requirements that are required by some of these companies, whether if it's an FHA, a VA, USDA, or a conventional loan, like what they're looking for in the basis of, like, if it's a bank or if it's Fannie Mae, which is a protected government protected loan, or a VA loan, which is veteran services. Um, these things have certain requirements where you should really look into getting approved for. So the first thing that I want to look at is look at these across the board. These down payments are three, 3.5, 0, and 0. That's not the 20% that we're hearing that everybody's talking about. So for me, and I'm going to get better clarification on this from my bank when I go over to my bank, is why is everybody asking for 20% when the conventional loan over here is asking for 3%? And then your credit score has got to be at a 620. Now, that means anybody qualifies for a house. Anybody who's paid one credit card off and has one car loan qualifies for a house. So that's great for the conventional. When you're looking at FHA, they're telling you with a 3.5 down payment, you can get a 580. With a 500 credit score, you can get a 10% down payment. You need a 10% down payment to get there. So all these all these things start to add up. So if we're like 10% of a house in a $500,000 market, you're looking at 50 grand. Is 50 grand easy to earn in today's day and age? Well, with the current climate of economics, yes and no, depending on who you are and what you're doing. If you're working a 9 to 5 job, no. But if you're doing something that's helping the community, yes, you're going to increase. You're going to be able to get your clients to get you that 50,000 a lot quicker than you thought that could happen. So, no minimum 620 for the VA and no minimum 640 for the USDA. So now I started looking at these other things, and it's mortgage insurance or similar fees. So these are fees to have these accounts. So now you're looking like PMI is an insurance anywhere between 0.14 to 2.33%. That's on top of your loan amount. Okay. UFMPI, again, another fee. And annual MPI is 0.15 to 0.75. So you're looking at this is another 2.5% in fees. This one's saying, VA funding fee, which is another, you always go on the high, never go on the low. Another 3.6%. Upfront guarantee fee is 1% over here, and this one's annual guarantee fee of 0.35%. Now, these are a 0.35% of the loan amount, not of your payment, of the loan amount. So you're looking at, 1% of $500,000 is $5,000. That's a big number. That's a big number for, and this is an annual, this is 1.35, which is like, say, if it's 2, it's 10,000. So you're looking at like close to like 87.50, no, not 87, 78.50 in fees annually for your loan. So to understand that your PMI, the PMI is reduced by putting a 20% down, because then there's no insurance fee, because you've already covered the house. You've already covered what they're looking for out of the house. So DTI, debt to income ratio, you're looking at 45%, 43, 41, 41. So they're looking for you to be able to have a debt to income ratio that is 45%. So your debt is only 45% of what you make. That's where they can add that. Now, how do we lower the DTI? You don't take on new debt, which means your credit cards are low. Your hold on. Your credit cards are low. Your excuse me. Um your auto loans, you're not getting auto loans. You're not getting stuff that's going to be crazy to put yourself out of whack. So what are you doing? You're keeping your income, you're keeping your debt ratio really low, which keeps your fundability and lendability high. So think about this. If I go purchase a home right now, right? Just use this as a home, as an example. Say I go purchase a home, and I have two car notes, and my credit cards are at $60,000, and I'm bringing in 70. My DTI is 90%. But now let's change that, and let's change it that I have $50,000 in debt, and I'm making 110,000. Well, my DTI now is lowered down to 50%. It's still got to be lower than that. So your DTI has got to be 43%. So you're only allowed to, in this case, 45%. You're only allowed to spend $45,000 a year in debt. So how do you manage that? Well, it's actually very easy. It's management ideas on how to actually pay for what you have. And don't buy unnecessary useless garbage. Okay? Um harder, everybody goes, Ali, a lot easier said than done. No, if you want a home, it's not a lot easier said than done, because if you want something that's going to be beneficial to you in your future and your family, whether it's you yourself or just anybody that you're with, you have to look at it as, what is it going to take for me to get there? What do I need to do to get there? And how much do I have to sacrifice? Um, Sacrificing everything is the key. I will sacrifice everything. I will sacrifice having a car. I will sacrifice having this, that, and the other thing to to get to that point. FYI, anybody who knows me right now, I don't have a car. I'm sacrificing my own car just so I can get a home loan when I'm ready. So I have no debt to income ratio, no debt at all. That'll show me that I'm in a bad situation. It'll show me that I'm in a good situation. My debt's very low. Most of my cards are paid off. My income my income is in the six-figure mark, so that I can make sure that, and my debt is like 1% or 2% or 3% of whatever it is, and that's done purposefully. That's done purposefully. And this is, guys, this has been set up over 5 years. This is not recent. This is like when I didn't have money, and I was just working my day job, and I was on a broker side. I wouldn't spend. I wouldn't spend, period. I would tell my wife, well, we're not going out. It's either buy foods or go buy food and go out. And when you look at it like that, it's like you have to know when to tighten the belt and how to tighten the belt. Because if you don't do that and you don't do it at the right time, you're going to shoot yourself in the foot. So when we're talking about this debt to income ratio, this is based on you. Loan eligibility for a single family home between 700,000 and 1.2 million. This one's 400,000 to 1.7 million. There's nothing applicable over here. So I kept reading down this, and the requirements. There's all different requirements for each and every single one, what they're looking for. And this is Lending Tree. So Lending Tree is going to look to get you into the best mortgage that's going to make them the most amount of money. So they're going to tell you. So you need at least at least 3% down. Adjustable rate of mortgage, absolutely not. You always want a fixed mortgage. You don't want an adjustable rate of mortgage. That means the mortgage payment and everything moves with the interest rate. Well, Ali, what happens if the interest rate is going down? Well, the other vice versa. The answer to that is what happens if the interest rate is going up. Let's go think back to 2020. Interest rates were at 2%. Anybody who's smart right now, take an arm right now, no problem. And then come 2020 after the election, it shot up to 7%, 8%. Your mortgage payment went up almost, if I remember correctly, on the same $2,200 mortgage, it went up to $3,500. So an extra what? $1,300 in payments? Absolutely not. We don't want an arm. Conventional loans. Oh, here we go. Conventional loans with less than 20% down require PMI, private mortgage insurance, to protect the lender if you default. If your down payment and credit score is lower than the PMI payment, then you will pay between $30 and $70 per $70,000 that you buy annually. That's not bad. 30 to 70 per 100,000. That's great. PMI premiums. These premiums are often paid as part of your monthly pay. However, you could choose to pay your PMI upfront in a lump sum closing. That's cool. Um, you'll snag the best mortgage rates and lower PMI with a credit score of 780 or higher. Well, that we know that. We know the higher the score, the better. So, employment, self-employment. These are not the best loans for self-employment. I'm going to let you know that right now. A lot of people have a problem with that. Income limit, debt to income ratio, cash reserves in the bank, occupation, cash reserves in the bank. Let's talk about that real quick. Anybody who's buying a house, okay, right now, anybody who's looking to buy a house and fixing their credit to buy a house, yes, you're putting money away to buy your house, but you also want to look at your bank account, and if you have 50,000 in savings for your down payment, you need to make sure that if your down payment, and just use this, your monthly payment is going to be $3,300. You need to make sure that you have $39,000 in your bank account, right? Just in case that's a year's worth of savings and payments, so you never default on your mortgage, and you always have things in your mortgage in savings so you can get to where you need to be. And again, a lot of this comes with good spending habits. A lot of this comes from putting money into savings and not going out to do what you need to do. Um, and it just focuses on you actually working towards that one goal that you have. Now, uh, investment properties, property type. Now, my thing is, let's talk about over here. There was something that I saw over here. These are, well, let's look at FHA. FHA is at the 3.5% down with a credit score of 580 or above. With 10%, you can go up to 500. You have to pay FHA mortgage, which is an upfront mortgage insurance premium worth 1.7% of the loan amount, which is technically financed into the mortgage. And then a mortgage insurance premium, which is MPI, which is 0.15 to 0.75. Always go higher. Um, Employee, self-employed, your documents, you need to be at least 2 years self-employed for an FHA loan. Income limits, FHA guides don't need to set any limits on qualified income. Debt to income ratio needs to be 43%. Okay. VA mortgage, if we want to go down there, we'll go down there because I can see this video is already getting long. Let's talk about this. Okay? This is what I wanted to talk about. These are the killers right here. And this is what our groups should be looking at. Investment properties and multifamily homes. Why? You can get an FHA loan for these both these properties for a single family house or a multifamily house. Okay? A minimum of 5% down payment is required, 680 credit score, right? And they include the revenue of the house into the amount that's being financed. So, if you finance that stuff together, excuse me, if you finance it with that items together, it will be fantastic. you will then be able to get your loan at a lower rate because the property is making money. Live in one unit for a year, get some equity out of it, take that equity, roll it over into another property. Now you have two properties. Now you can go buy yourself the home that you're looking for because now you have the properties to pay for it. Ali, is it that easy? Yes, it is that easy. It's just finding the property and finding the place that you want to live that has those properties to be able to do it for you and to find good tenants. You can become a landlord like the people that we're paying right now. You can become a landlord just as easy as the person that's landlording right now by understanding how to use a loan to get that piece of property to then grow to where you want to be. Okay? Look, I'm going to include this Lending Tree link inside of here. I want everybody to read through this. I think it was a great read for me. Um, I'm not going to say that I know everything, but at the end of the day, I know a lot. And mortgage is my next thing that I'm going to attack. I'm attacking on the multifamily home front because I want to get a multifamily to then be able to build my portfolio for when I'm ready to buy a home. I may not be ready for 2 years. I may not be ready for 3 years. But if I get that multifamily, those 2 or 3 years, that's equity that's being built into that multifamily, which then I can pull that equity out at any time, right? Refinance, pull that equity out at any time, pull the equity into the home that I want to buy. And for example, say that in both buildings the equity is $200,000. I can pull $200,000 out, or from each one. That's 400,000 at 20%. That's a $2 million. That's a $2 million place. That's a $2 million place that now I can purchase. That I put 20% down, which I'm only mortgaging out for 1.6 million. So that's how easy it is to see how these numbers make sense. And if you want to own a mansion one day, that's how you do it. It's as simple as that. All right, everybody. I don't want to get too long-winded on this, but this was the video for today, and tomorrow we're going to have a mastermind. So whoever watched this video, tomorrow is going to be 10/25/2024. We'll be having a mastermind tomorrow where we're going to be going over the credit software. We're going to be doing Q&A for anything credit related and funding and business related, and we'll go from there. I'm also going to start looking into having people post in our groups on business items and people trying to buy businesses. So be ready. We're going to have a lot of things coming, guys. All right. Bye-bye.